welcome everybody. Let's talk real estate, your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. It is Tuesday. I am Barry Saywitz, president of the Saywitz Company, and we are back here again. We're talking a little bit of real estate. Before we get going, I do want to do a post shout-out, if you will, shortly after Mother's Day. Happy Mother's Day to my mother and all the other mothers, acting mothers, pseudo-mothers, anybody who pretends to be a mother or is actually a mother. We appreciate everything that you do, and hopefully you had a nice day over the weekend. With that said, I want to welcome our guest, Phil Matchett, Director of Commercial Investments and Asset Management for MIG Real Estate, headquartered here in Newport Beach. Phil, welcome to the show.
Thanks for having me, Barry.
Yeah, so it's been a while. You and I go way back, both UCLA alumni, which is at least 50% of the reason you're on the show. And you've had a long career in real estate. You've seen many ups and downs. And so I thought it would be good to have you on the show and talk about not only your career, but the sort of trends in the markets and then play it forward to where we're at today. And with all of that said, I want to go back to the beginning because UCLA, great stomping ground. I enjoyed my time. I'm sure you did as well. We had the same ridiculous major, I call it, because it was a Bachelor of Arts in Economics, which taught me a little bit about a bunch of stuff and not a lot about a whole lot of things at the end of the day. But when you got out of school, was real estate the plan, or was that always part of the thinking? How did that go?
Like you said, our economics, it was so varied. I tended to go towards the number side. So I went into more the finance and accounting world. So I actually left UCLA. I went to work for a company called CCH Computex. I was in their finance and budgeting department, and that's the route I went. And then through that position, I coordinated with Deloitte & Touche. They were auditors, and I actually moved into public accounting for about 3 years. And actually, my wife is my girlfriend from UCLA, first year, so we made it all that time. And we're now, so I moved to Orange County, and I moved to Deloitte & Touche right over here. And
by South Coast Plaza with their name on the building.
They're there now. Yeah. We were in a little office right off campus over here, little, and did my 3 years, and then got through that and became a controller of a medical imaging company, and then figured out, medical imaging technology. Not the world for me. Technology was getting cheaper. We had over-leveraged machines and harder to make money. Got a call from a headhunter, and that kind of got me into the next world of real estate here in Orange County.
And that was at a time, late 80s, sort of early 90s, right? Late 80s, market's still booming, Orange County really growing and really expanding. So it was a good time to get into real estate at that point.
Yeah, it was right at the peak. I actually worked for a company called Tulane Company.
Yeah.
And we developed Jamboree Center and Western Digital Building, as we know it. That's no longer named that. But we developed those buildings for the Irvine Company. And that kind of gave me the connection to all of Orange County real estate. And I got to meet a lot of great people at the Irvine Company. And even to this day, a board member of MIG is Dick Sim. That's where I originally met Dick Sim when I was a young guy just working the development department at a Tulane Company.
And those were some marquee projects back in the day. It was just dirt right off the freeway and some orange trees and stuff. And then all of a sudden you have high-rise buildings and hotels and really A-class office complexes.
Yeah, it's for a young guy to watch it just go up and really see what it took to develop, and the eye that even Don Brennan would walk the project, and you could see the eye he had for detail. And as a young guy, you go, wow, he would pick that stone's not right or that tree's not right, and you'd heard the stories, but as a young guy, just to see his eye for the fine detail of those properties and really what went into them, those are true landmarks, really, the stone and everything that's in them.
And really, it was a story of if you build it, they will come. Our first office was in One Park Plaza, so I watched 3 and 4 and 5 get built. And you'd watch them out there every day with the cranes. Yep. And the next thing you know, hey, there's people running around and there's cars in the structure. It didn't take long to fill those things up.
No.
And then it turns, right? And, and then all of a sudden, in 1989, that's when I started. I tell people I started in October of 1989. Market crashed in November 1989. And then early 90s, pretty tough goings. But you stick with it, and you, in your career, you're with some very large and reputable real estate companies.
Yeah, you're exactly right. So we went in the downturn. Jamboree Center was finished. What's a young guy do? I found myself driving to LA just to do what needed to be done in tooling companies. So we'd go to LA. I worked actually on Wilshire Boulevard. I worked in the Westwood Gateways. Right. And then I had a special project where I went to San Diego. There was large Plaza La Jolla, it was called at the time.
Yeah.
It was going back to the bank, and I think it was the Summers Companies. And I got introduced to a company called LBA at that time. And
they were just getting going, and then they really took off, really coming out of the recession.
Correct.
One of the few guys, along with my buddy Dave Colton, and people that there were really only about 3 or 4 companies that were really out there buying office buildings.
Yeah, so we stepped in a lot of times for the lenders, and we made our niche, working them out and getting them stabilized somewhat or put together and getting the information, and then helping them sell them to the next investor. Yeah. And that's where I'm from. Thule. I was at Thule, but I was working almost hand in hand with the LBA team. And that's where I really got to meet Steve Layton, Phil Belling. That was pretty limited back then. There were only 6 or 7 of us in the company when I moved over to LBA.
And ride that through the next sort of cycle up to the recession, right? Fixing buildings up, there's appetite for people to buy them, and then recession hits 08, 09, 2010. Tough goings for everybody.
Don't
want to relive it.
Don't want to relive it. But about that time, I started, through the relations there, I actually moved over to Car America. So I went to a pretty prominent REIT. They were out of Washington, D.C. They were backed by Security Capital. I was like the first employee hired on the West Coast.
And they were buying.
They were a REIT structure. You didn't need
had money.
Had money. You were going off the dividends. You had to produce a dividend. You didn't really have to produce a high return. So that was my foray into the public company world.
And so after that one, I'll say ran its course, but then you get introduced to the folks at MIG.
Yeah, I had a short stop, I had another 5 years. From Carr, I went over to a company called...
to Bircher, right?
To Bircher, Bircher Anderson. So I worked with Art Bircher and Mr. Anderson, Bob Anderson, and that was my foray more into the JV world, JV equity world, I'll call it.
But that also has its ups and downs, right? So I remember those because they were bringing in foreign capital, they were bringing in investment partners, had money, buying deals, same kind of thing, fix it up, try and reposition it, increase the value, and then the market bottoms out while that's going on, and nobody's buying. And then if they are buying, the number's 60 cents on the dollar from where you were.
So we went through the whole thing. Yeah, your JV equity, you got to find it. You got to get lenders. We were talking earlier. We did well, but we didn't really lose a building because of non-performance. We lost it because we had to refinance the buildings.
Yeah.
They wanted more money in. You look at the numbers. Okay, it doesn't make sense. So in that case,
just give it back.
Give it back. And we were just working for the banks for a good period, and it was just a time. Like you, was having two kids in college, so I had to figure a way to make sure I had that situation covered.
And then you go to where you are today, so MIG, different ballgame because family-owned business, not out running around trying to raise capital all the time because they have the capital.
No, very appealing. Not sure, does everybody know the MIG story and who they...
I think you should tell.
Yeah, okay, it's a great story. So, yeah, not many people really knew who MIG Real Estate was, and... If you look out the windows, here we're sitting in UCI, it's the Merage family. So it's Paul Merage's family, and they formed a real estate and an investment company. But the true claim to fame is they had a food company. It was in Denver, and they invented Hot Pockets, things we all survived on during college. And they, at one point, sold that company to Nestle for a considerable amount of money.
Yeah.
Everybody can go online and see what it is. But yeah, they did. They took the process, they marketed it, they were forward-looking on how to make the product, and
I still eat them today.
Yeah, they are good.
And so, but they took the money, and I don't want to say they ran, but they took the money and then took a different path, right? So instead of starting up another product-type company, took it into real estate, took it into charitable donations, both here at UCI, religious donations for the JCC, and all kinds of other things to put their success to good use for other people. So certainly we appreciate that. And then took to the real estate.
Correct. Almost 14 years ago, I was one of the, I think I went there. There was only 7 people there also. So it was early startup. They initially tried to invest with the funds and with investing JV, and didn't turn out as well as they wanted. So they said, let's control our own destiny. and basically started their own real estate company. And you're right, yeah, they moved from Denver, they came here, they started all over and have made a great contribution to Orange County.
And so the play has been, since that period of time, it's now been for you, 14 years, right? So long run. And again, watch the market run up in this last cycle, and then now, I'll just call it, we're at a different place and new challenges. But the play in the past has really been for the family investment on the office side, right? For the most part. And for the most part here in Southern California.
Correct. So we have about, I think we still have about 5,000 units of apartments, multifamily. Yes, we were an office company mainly when we got there, but we watch trends pretty closely, and we watch where we can achieve our returns. We may be a family business. Yes, we have family equity, but we operate much like an institutional company. We have a board of directors. We have some pretty prominent names on our board of directors. So we have an investment committee. So we don't treat it as, okay, we like it, we're going to buy it. We have to do the formal process of an investment committee memo, and it has to hit a certain return. We compare our returns to other alternative investments the family is in. So if it doesn't hit a metric for the risk reward, we'll just pass on it.
And you don't need to make the deal, so
no.
It really has to stand on its own merits.
Every deal stands on its own merits. We are a fund somewhat, but every deal stands on its own merits.
And so the underwriting of it, the analysis of it, that is really your world in terms of either identifying the deal or somebody brings it to you, and then you got to package it up and go, hey, does this make sense, or I think it does or it doesn't.
Correct. I have a close compatriot that I've worked with for almost, he's been there 14, and we worked together for another 5. You know him, Kevin Stiles. We worked together for almost 20 years. So we're very tight. We know he does most of the investment sales. He's that guy out looking and hunting for them, but he and I work very closely. And if I don't think we can hit the underwriting and believe in the market and the underwriting terms we're going, MLAs or anything we have, we probably will pass on the deal. Yeah. We're very, not constrained, but we have discipline, I'll use the word. We will not. We look at it as family money. We got to make sure we get the family.
It's a long-term hold. It's a long-term strategy. There's no buy it and flip it in 3 years, right?
Every one of our holds is on a 5-year analysis. So we do look at it as a 5-year hold analysis. We do a 10-year, as most institutions do, but we look at it on a 5-year horizon. And do we own assets still that we bought when I started? Yes. Yeah. So we do have assets from 14 years ago. But we have gone from an office-dominated commercial side to really, I think we're down to 5 office buildings and 1 retail center.
And is that a function of COVID or a function of just I can't get the returns in today's world, so I got to look for other investments or other sectors that will get me there?
Yeah, COVID wiped out the office world for the most part. And we're value add. We were value add offices. We tried to be in markets where we thought there was growth and there was reasons to be there, but we all know what happened in COVID, and only the best office buildings, in my opinion, will be viable going forward.
And even some of the nice office buildings in downtown LA just can't make it and can't pencil at the end of the day.
What everybody thought there was a downtown coming before COVID, and everybody was moving down, live, work. I think we saw the opposite after COVID, where select suburban office has done much better than downtown. Yep. We all know than downtown.
Yeah, because people want to, even if they're going to work or if they're doing a hybrid, they want to be close to home. Nobody wants to commute.
No. So if you're going to be near your work, you'd rather be in the suburbs where you can do what you want to do, I think.
Yeah, no, I agree. But you had properties, and still do, Los Angeles, Orange County, San Diego, all of the prime markets throughout Southern California. But we were talking earlier, the trend really recently in the past several years, since COVID, has been to look outside of California.
Correct. So I think we're down to about 3 commercial assets in California, and the rest go from South Florida, big presence in Austin, and we moved away from Southern California just through yield and where we thought populations were moving, that population that would drive. We do a lot of analysis on where people are going and what's driving them to go there. And we look at the governmental, we look at the tech, we follow the tech where they're going. So that was a lot of what we do analysis on, and we followed them to where they were going. And again, yield. You were trying to get where you could still get the returns you needed. And that kind of moved us out of California.
And when you say yield, is it cash flow yield or is it value add at the end of what?
It's value add. We try to hit a 12, 13 leveraged IRR. So that's still our metric today. And we've been pretty successful at doing that.
And so some people would say, look, California, while the returns from a cash flow standpoint are much less because the deals are thinner, the opportunity for the property to increase in value seems to be exponentially better than maybe other states. And I would just say that is true, there's no question, but also the harder they fall, the harder they run up, the harder they could fall. And so if you get into a downturn or you get a property that's struggling or you get a sector that's struggling, the property is only worth what the rent will yield. And if you can't fill the building, it's a problem.
Correct. Don't know what the question actually is in there, but
well, the question is, I guess the question is, I go where I can get the yield, and so now you're looking at Florida and you're looking at Texas, and these are, by definition, much more governmental-friendly states, and states that have sunshine and good weather where people are migrating to. And so how have you found it in terms of moving out of California? Successful and welcoming?
Definitely successful. They all come with their idiosyncrasies. Florida, we've all been hit pretty hard in the commercial world on insurance. When you move to Florida, guess what you got? You have hurricanes. So you have to take that into account. I will say Austin, that's our largest market. And Texas, from my point of view, we all know what we deal with tenants and the eviction process.
Yeah.
I would say that's usually the most time consuming, and it is the most commercially friendly to the landlord. You have very little barriers to getting your space back, which allows you to go release it.
California's got to be the complete opposite end of the spectrum, where it is ultimate tenant friendly. In Texas, not so much.
I think the only one that's surpassed California now is Denver or Colorado. I think their tenant eviction process has become even more tenant friendly than California.
Yeah, and regardless of that, in California, not to bash on California because we're here and we live here and we love it, but the fact of the matter is, a very difficult place to do business.
Even on the commercial side, which is far easier than what we're all finding in the Seattle areas, the Denver areas, at least you know the process here, but it's a minimum of, can be 90 days before you maybe even get a tenant out.
Yeah, and look, on the apartment side, it could be 6 months. Everybody wants a jury trial, and then during COVID, there were people that were squatting it for up to 2 years that just didn't pay the rent. And so if people believe they can get away with it, then maybe it changes the behavior. Commercial's better, I think, but it's still a long process. The idea of a 3-day notice, in some states, and I won't say which ones they are, but I know they're out there. If you don't pay your rent and the landlord gives you a 3-day notice, in 3 days they come and they take your stuff and they put it out on the lawn. In California, that 3 days, it could be 300 days, right? It's just,
no, and that's,
you don't know.
And that's Texas. The beauty of Texas is if you don't get your rent paid on time, after you've served them the legally notices, you can put a lock on the door. Yeah. And not only that, you don't have to put their stuff on the lawn. You own their stuff. So
and then they have to pay you to come back and get it, or you just throw it away.
Yeah, it belongs to you.
Here you have to hold an auction, supposedly, and you have to run an ad in the paper. If it's over a certain value, you have to give them time to come back and get it, or you're stuck hauling away somebody else's junk.
And that's not cheap.
No.
That's usually one of the highest costs we have is, what do you do with their stuff?
Yeah.
We just had a tenant in Florida move out, and they left us with a whole bunch of shrimp.
Really?
Power got turned off. What do you do with a freezer full of shrimp? We got to get rid of it. That's very costly.
Yeah.
So,
and on the commercial side, you were telling me that really the trend has been, while you do own a bunch of apartment buildings, getting out of the office sector and really going into the industrial side of things, whether it's multi-tenant or single-tenant. Industrial seems to be the darling sector, and a lot less out-of-pocket expense in terms of tenant improvements.
We made a big push out of, I call it flex industrial, small bay.
Yeah.
So it's low risk. I have a theory on, we follow, like, you try to keep your largest space under 20,000 square feet. You start getting above 20, in my mind, you start having a big exposure in a property. But yeah, the 20s and belows, that's their business. They're like, what's office? $70 a foot to fit up? Maybe today.
Yeah.
Maybe you're putting $1 a foot into a small flex bay tenant.
Right. $2 worst case
scenario. They release very quickly. You don't have a lot of downtime. You don't have a lot of exposure.
And if somebody falls down, the cost to return it for the next guy to get it ready is really paint and just demoing out whatever is in there that somebody doesn't need. You're not building a whole bunch of new stuff, whereas in the office, you're redoing it, or in the apartment, if it's trashed, you're putting in new appliances and floors and countertops, and it's time and it's money.
Correct. So we spend a lot of time when we're looking to do a buy at what is the percentage of office. So we go into each space and really take a hard look of, was it 80-20, is it 30-70, and we really allocate enough dollars to make sure if that guy does go, that we can take it back to the optimum 80-20 in my mind, where you have 20% office, 80% warehouse, so the next guy can just come in very quickly.
Yeah.
Maybe you put a little carpet, you paint them, and you're ready to go for the next guy, probably within a week.
Yeah. Really not a big turn time.
No turn time.
And if somebody does want some specialized improvements, it would be your problem, Mr. Tenant, not necessarily my problem as the landlord.
Yeah, so that's where we moved our commercial portfolio. So that's, I think we're up about 5 million square feet, and 4 million of it is small bay industrial.
And is that going to be the strategy going forward? And will it be in the states that you're already in, or is there some new horizon for you?
I always go on the theory of concentric mass. You and I trade on information for the most part, so...
You go with what you know, and if it's working, I think you ride her till she bucks you. Right?
And it's more, okay, we all work in a group, and if it's per se Austin, let's take our Austin portfolio. We own stuff in the southeast, we own it up north, we own it in the central. My theory, again, is trade on information. You know where the deals are going, you know all the brokerage community. You have to have enough mass to really understand where these deals, we can see a deal in the southwest and try to pull them to a building in the north.
Yeah.
So if you have one building in any submarket or market, it's very hard to get a footprint, compete against the local people. We found Austin. We got a good footprint in Austin, and we've been very successful. And we're looking at Dallas, but that's a big pond with a lot of big players. So you're breaking into the big names of real estate who own a lot of real estate in Dallas.
But in terms of other states other than Florida and Texas, do you find that those are good ones to be in and you'll continue to expand there given the opportunity?
Correct. I think we found South Florida for all the reasons you stated earlier. Austin, we love the tech. We love who's there. There's a lot of medical, biomedical. There's robotics. You have the whole big gigafactory.
Yeah.
You have all the Dells of the world, and everybody's still there. We've done a lot of analysis, and that's what we follow.
And do you find that the cap rates in these markets are better than Southern California, and that there's also value add upside on top of that?
Yes, I think if you ranked them, I got my notes, but I think if you ranked it, Florida's probably the lowest cap rates right now. And then maybe you move to Phoenix, and then Denver's definitely at the bottom right now. It's a market that's in, I'll call it, disarray.
Yeah, for many reasons.
For many reasons.
It all started when they made weed legal, and people started making bad decisions.
Yeah, exactly. And it's become very California-esque, I call it. There's a lot of regulation. There's a lot of tenant friendliness. You got to put if you're in Denver proper, you got to put a grass roof on your building if you replace it. And we know what roofs cost. How do you double it by something like that? So we do have a portfolio in Denver, but we're just watching it very closely. But I think you'll see us continue in Florida, Texas, and Phoenix we like.
And is California even on the radar in terms of looking around, or not so much?
We look.
Hard. Just hard.
Hard. Pricing's high.
Better be very compelling.
Yeah.
Better be right next to something I already own.
Exactly. You got to be able to leverage on something. And if you don't own another asset, and the pricing and the regulation, and it's tough to do business in California for these little guys. And we're watching that closely with tariffs, wars, inflation, gas prices. You're starting to see the little guy in these small bays. What is their breaking point?
And they're struggling. And so look at you look at gas in Florida or gas in Texas relative to what it is in California, and that alone is right off the bottom line.
Right. When on the drive-in today, I was listening to Bloomberg, and it's gas is up 5.5%, inflation 3.5%. When a dummy like me goes and buys a new Tundra, and now gas is $6, it's should have bought that Tesla.
Yeah, for sure. And then soon you'll be able to take a nap while your Tesla drives you to work or wherever you're going. But there's no question that Southern California has the cost of living really is through the roof. And I find that the operating expenses as a property owner, I'm curious your thoughts, but those all continue to go up, whether it's utility costs or landscaping or trash, certainly with all the environmental regulations. And so if you're not able to pass those costs on to the tenant, or at some point there's only so much you can pass on without getting a flack for it, it's also challenging on top of the insurance and on top of just trying to get a return?
You're 100% right. I hate to say it's almost in every state where one variable or the other is pushing you. It's either property taxes. You're finding states that maybe didn't have the property tax increases that we have, but you're starting to see it everywhere. It's, okay, you go to Florida. Insurance in Florida, not only is insurance expensive, it's going to be more in Florida.
Yeah.
So you got to weigh those, and then you're really competing against long-term holders. So if you go into a market and their basis is so much lower than yours, or they don't want to insure to the level that
Right.
you are, you're competing against a gross rent, and their gross rent is face-based, may all be the same, but if their expenses are half of yours,
then how do you compete?
How do you
I love
compete?
I love it when the broker, and I'm a broker myself, but I love the broker says, "Look, the expenses are really low." And I go, "But those are your expenses. Those aren't my expenses. I can't get that guy's insurance. It's over as soon as you sell it. You got to start over."
start all over. That's Texas now. They fund a lot of what they do now, I think, through property taxes. So you have these huge increases. So and they're all odd on how you have to go appeal them and fight them and see what you're going to get. And that creates uncertainty. Where are you going to be next year? Are you going to pay another $500,000 in taxes, or are you going to get it back? And how do you keep your cash flows and really project good, knowing all these variables right now?
And you're surrounded by, at your company today, well-heeled, wealthy, successful people that really, I believe, have a long-term strategy for themselves and their family. What is the discussion around the kitchen table, if you will, in terms of the prognosis for the economy and then the real estate as a whole? Because there's talk that interest rates will come down, and then I don't know what that does to cap rates or anything, at least in the short term. I'm curious your thoughts.
Good question, but I guess I don't have the crystal ball. I mean, I would have thought interest rates would have started to fall already. They were slowly going down, but now we've got other issues going the other way, and I don't know.
And my thought is even if interest rates come down 25 or 50 basis points, it's not going to move the needle for anybody.
No.
And it's not going to affect your loan. And then people that are investing, that are looking for a yield or looking for a return, there's a bigger picture conversation. Certainly getting debt at a cheaper rate helps. But I feel like there's also a disconnect still between buyer and seller, where the seller feels if interest rates came down, you should pay me more for my property. And that's not a moving argument.
No, it's not really. And what we're finding, too, in the product we like, you're now seeing I call it the big guys. The bigger investment guys are now coming in and seeing the advantages of this flex light industrial, where they can get their returns and buy good portfolios. Yeah, but on the flip side, the big Blackstones and the Lynx and those guys are actually selling out of it. And so it's just an odd time in the investment world, in my mind. It's where do you go? Where do you find the return you want on an asset you want? And we're not going to go out and buy a 10 million square foot portfolio.
Yeah,
we're not that guy. We're going to go buy select assets, select portfolios,
and just add on
and buy and sell. And we hit our strategy year, even 2 years, we'll trade out and we'll reinvest. So we'll go find another deal that will hit our returns going forward for maybe a longer period.
Yeah, no, that makes perfect sense. And then I guess I'm just curious your thoughts. It is an election year, all kinds of stuff going on in California and at the national level. What do you think are some of the big factors, like when you guys talk about at your company, that will impact the real estate? Is it, I feel like it's all the above, but I'm going to ask you the question anyway. But is it really inflation, or certainly it doesn't seem like the war is getting over tomorrow? And then how does you see the stock market all up and down? How do you try and stay the course with what you're doing with all these other outside factors bouncing around? It's tough.
No, it's small bay and flex is somewhat like multifamily. You are managing a lot of, I think we have 600 tenants.
Because you're dealing with small business
Yes.
owners. So the good news and the bad news, like you said, I think, is that you aren't going to get burned by one company going bankrupt or out of business or getting bought, or their product, whatever they make, becomes obsolete. So the risk of a smaller tenant is not going to tank it. At the same time, I do feel like with the smaller business owners that we have in our portfolio, some of their problems become your problems. Right? It's not an unemotional decision. It's not purely business, right? Somebody gets divorced, I can't pay the rent. I got sick, and nobody's watching the shop, I can't pay the rent.
No, and that's a good point, because we're actually paying a lot of attention to that right now. I guess there's a daily or bi-daily checking of the AR,
Yes.
What's going on right now in the small tenants. And it's, if you give them 1 month, next thing you know, it's 3 months. And
yes. Or you do the payment plan and then they default on. I had that meeting last night. I gave you the payment plan was rent's due on the 1st. That's the first payment plan. Then it's you go to 2 times a month because you can't get it all on the 1st, and then you're behind, and I make you a payment plan, and then you default on that, and at some point you just go, hey, this is not really working out.
No. So we spend a lot of time that right now, really analyzing or really looking at the AR, going, okay, we got to keep this in line, and it changes your strategy interim. It's okay. Yes, we're a longer term holder. We want the cash flow. Do you go short-term deals, lower the rate just to keep a tenant today and help them get through what they're in? And most of these guys, gas prices are up $3-4 a foot. They're not making any money. Yeah. Who are they going to pay?
And then the question is, look, how long do I have to do that for? Because you go back, everybody did it in COVID with tenants that they certainly didn't want to go under, or people did it in the recession. And then you got to look at historically, what are the percentage of those people that actually say thank you, get back on track, and become ultimately successful versus the ones that you just prolonged the inevitable?
Yeah, I think you and I have been doing this long enough. You know pretty quickly who those people are, then you lose pay.
And then you got to rip the Band-Aid off.
Yeah, very quickly. That story I've heard of dog eat. I call it dog ate my homework. It's check doesn't show up, and you know very quickly, and you know which ones tear the Band-Aid off, just get them out of there and hope that you can release it. It may be less. You may spend a little money, but at least
sit, right? Yeah. And so you just that's the take your lick and try and move on.
Yeah, live to fight another day, as I say. It's
And the difference, I guess, in Texas is if they are behind, at least you can get them out quickly. Versus in California, what if they don't want to go and they squat it?
Well, then you could be there a year. I mean,
and then you're not getting anything, and then they're just saving up money so they can move or do whatever they're going to do. It's a horrible. We'll leave that in the negative column, right? But and so in terms of activity, are you more active in terms of buying now, or have you pared it back and really trying to be more selective in terms of what you're doing?
I think we've been more selective. We went on a pretty good, I don't want to call it buying, so we bought some nice portfolios. We bought one in Florida, we bought one in Austin. We're absorbing that, looking at the market, seeing really what's going on and where pricing's gone. Florida has gone since we bought there. I had gone off the charts.
Yeah, through the roof.
Through the roof for small bay industrial. And now we're even, I think an asset we've owned a year and a half, maybe almost 2 years, we're taking it back out to market. We proved out the rents. We're highly leased. We saw a trade up the street, similar asset, maybe not as nice. We're like,
and we call that skimming off the top, or whatever the official term of that is. Hey, I've accomplished what I wanted to. I'm going to take my profit and I'm going to move on.
Yeah, we're value add guys. We proved it out. I think we've created our value. Are we going to create any more? We forward look. We say, what is the return on the imputed equity that we have left in the property? So we look at that a lot. And if it slides somewhat below our return threshold, okay, let's take our money and let's go back and find an asset we think we can find, and let's get back to that other higher return threshold for the next 5 years.
And just do it all over again.
But yeah, we do it, and we're 1031 investors, so we're buying, selling all the time.
Yeah. And so, and what do you think is the prognosis for office? Is there one? I feel like here in Southern California, the prognosis for a lot of the suburban, outdated office buildings is knock it down and build something else because it's not the highest and best use. And the buildings that have these larger parking lots, that's worth more value than the structure itself.
I think you'll see more and more of it if you can make the economic sense out of it. What does it cost to convert an office building? Is it cheaper just to tear it down? I think anecdotally we own a great flex property in Denver, and there were 2 office buildings, and they literally tore them down and are building multifamily backup on them.
Yeah.
They were going with the conversion, but they just figured out it was...
Couldn't do it. Right?
Couldn't do it.
So
Too difficult.
Say just start over, right?
Yeah, they started over. They just were like...
And you either build mid-rise apartments or you go... Look, you even see it here along the freeway where, you have industrial buildings. You're like, that industrial building doesn't really belong mixed in with apartments and office buildings. Doesn't seem like it really fits. And then yet you look at it and go, that throws off a higher rent than the nicest office building around with less out-of-pocket expense.
I don't have the crystal ball on office. I think there'll always be a need for office, but... What is that? I think everybody was touting back to office, but I listen to Bloomberg a lot in the car. So one of their comments was, "How do you get people back to the office now when it costs them $6 a gallon to drive to the office?"
Yeah,
it's
yeah. And even if they are coming back, a lot of the companies that we talk to, they'll allow some sort of a hybrid. or you even have the executives that aren't particularly excited. I find that most of the real estate companies, although you're telling me you guys don't have office space anymore, I need my people in the office. So I need the interaction. We need the synergy, and we need the ongoing minute-by-minute interaction, because stuff happens all day throughout the day, as opposed to my brother, who hasn't been to his company's office more than a dozen times since COVID hit, and is happy to sit in a chair and do a Zoom and do his own work. I think it depends on the industry as well.
Yeah, and us as a company, because we have spread out across the country, so a lot of my interaction is with the leasing teams and the property management teams in other markets. And it's funny you say that, because Kevin Stiles, again, we worked together for 20 years, his office was right next to mine in our 660 building.
Yeah.
And we talk more and have better interactions now
Than when he was
and
next
more
door.
in depth and more going through analysis together and talking to brokers when we're buying and selling than we did in the office, because of the disruption. It'd be like, he'd come in, oh, can we talk? No, I'm on a call. You keep passing in that office. This is my opinion. I think my side became far more efficient being at home and focused and
give somebody the attention.
Yeah, the teams calls up. Okay, we got a team call. We're going to talk about this asset. We all get on. We go through it. We go through it very quickly. Nobody gets disturbed. You can be working on other stuff on your computer, but you're listening and focused, in my opinion. My time efficiency has gone way up, I think, since not being in the office. And I'm an office guy.
Yeah, I hear you.
And I like the office, and everybody would say, I love being with people. But from an efficiency and getting stuff done,
If you're on a Teams call or a Zoom call, you're not technically lonely. There's someone right
there.
Right?
Yeah.
So you can talk, they can see you, and there is interaction. But you also can, once you turn it off, you're back on your own again.
Back on focused again on what you were doing when the call started. Yeah.
Yeah. Look, I'm glad we had you come in and got you all dressed up and out of your cave at home. And I appreciate you coming in and sharing your insights on the market and also on the business strategy. And certainly wish you continued success for you and the family and the company. It's been a long, successful road for you and for MIG, and happy to have you come in and chat with us.
Appreciate it. It's been a couple of years we've been trying to do this. I think you invited me in, and finally this is the time.
So good. If people want to find out more information about MIG, what's the website that they can go to?
MIGREF.com.
Got it. All kinds of fun stuff there.
MIG Riff, yes.
And look for Phil. He's going to be on a Zoom call or a Teams call. He will not be in the office. Me, you can find in the office struggling away.
We know where you are.
Yes.
Same office, yeah.
I'm either here or I'm in some other office. Good. I would just say, look, for everybody else out there, thank you, as always, for tuning in, listening in. Hopefully we made up something or taught you something that you can take away and use at the dinner table or in your daily routine. As always, a big thanks to everybody here at OC Talk Radio for making it happen. I am Barry Saywitz. We'll see you back here next week on Let's Talk Real Estate.
There you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California, Irvine's Beale Applied Innovation Center.